Hello, earnings season right now, and we're expecting some of the biggest companies in the US to actually report their earnings in the next few days. Today, actually, we're expecting for Netflix to do that. Lockheed Martin, Johnson & Johnson, Hasbro. You can kind of see here the notable earnings module, which kind of tells us about a lot of these companies, a lot of well-known companies that are about to be reporting here. You can see the full list in our tool, AT&T, for example, here and more of these companies. You'll see we have quite a few here. These are S&P 500 and basically Dow companies, Coca-Cola as well, McDonald's, a lot of companies for which we're going to be talking about in detail in the upcoming videos. Now, in this one, I wanted to talk about the IBM earnings, what happened with IBM there, and kind of take you through the stock analysis and the stock metrics. See whether it actually makes any sense to be buying IBM right now, as it's about to be down maybe 5 to 6% when the market opens in about an hour and a half or so. It's about an hour and a half actually from now. And we're going to be examining the finer details. Now, if we take a little bit of a look at the stock news here, you will see that the company had its Q2 earnings and revenues that beat estimates. But why is the stock down? Let's take a little bit of a closer look at the earnings report. So, as you can see here on CNBC, IBM shares slide after company trims cash forecast. So it's about guidance pretty much, not really what the company did in the previous quarter. Let's take a little bit of a closer look here, see what happened. Now, IBM shares slid as much as right now is like 5 to 6% on extended trading on Monday after the company trimmed its 2022 cash forecast. Here's what the company actually did for the quarter. $2.31 per share versus $2.27, so they beat on earnings on EPS level basis. And in terms of revenue, 15.54 billion versus 15.18 billion, also beat on revenue here. Now IBM's revenue rose 9% year over year in the quarter, as you will see, and income from continuing operations increased to 1.47 billion. So these are good things to see for the company. It looks like they are doing better. And the reason why things are going south right now in terms of the stock price is, as you can understand, basically the guidance that the company gave for 2022 as a whole. As you can see here, management called for 10 billion in free cash flow for all of 2022, which is down from the range of 10 billion to 10.5 billion that was provided back in April. So this kind of lowered guidance really plays a role in the stock market, and the Wall Street never really likes that whenever you get guidance that is early estimate, and especially if it's going down, of course, you do tend to get some negative reaction, and this seems to be the case with IBM, even though they did beat earnings actually this season. Now you can see the finer details here in the article, like IBM reported 6.17 billion in software revenue in the second quarter, which is up 6%, but below the 6.3 billion consensus that they actually thought they would be achieving. Now, of course, you can understand like the strong dollar, the overall weak market does play a role in what has been happening with IBM, but it looks like they are doing a little bit better. Now, their margins have also narrowed a little bit, which you would also kind of expect here. And the margins will be getting lower for some of these companies, maybe for a lot of companies really in the markets right now. Again, because we are having a little bit of a downturn in terms of the economy, that's for sure, and everybody has been affected. Now we're gonna be taking a look at the financials of IBM by taking a look at our metrics module here. We'll go back to that, and you will see that IBM has been a company that, if we take a look at the 5-year chart, is almost like flat, like it's flatlining. It's almost like dead here. And it's just going up and down a little bit, and then pretty much coming back to this range here, about 130 and 140 for many years. This is 5 years again. Now if we take a look at the max chart that we have here, you will see that over the years the company has been increasing its value, yet since 12, 11 or so, it has been going down and it has been losing value, and of course this is not a pretty picture to see. Now this could also be an opportunity after many years of the company losing value, but This definitely has to do with what they are doing in terms of the financials. And you will see that it's 1 year high, basically almost unchanged. Again, the company doesn't really move. We kind of saw that in the 5 year chart, and if you take a look at the 1 year, it's the same story. They have had some slumps, some downturns, and then some upturns. It's trading at about a range, pretty much for forever, since forever really. Now, in terms of its financials, the P ratio is going actually a little bit higher than what it used to be, so 22.7, pointing to worse earnings, which is something that you don't like to see, especially when back in the previous years with a lower PE, the price of the stock was actually at about the same level, or even less. And so you don't really like to see that in comparison to the previous years. Now, the price to free cash flow, though, has been relatively low here at 12.3. It's actually pretty low, but it has been lower again. It's another a little bit concerning aspect of the company. Now, the outstanding shares in the previous years, the company has been decreasing their outstanding shares, that is before 2017, but lately still decreasing at a little bit of a lower pace. At some point, it used to be more than 1 billion in terms of shares. But in the past 5 years, they have been decreasing that at about 3.6%, which is good, of course. It's a good thing for investors. Now, they do seem to be having a little bit of extra debt, a little bit more than I would like to chew here, and we're going to examine that in detail. You can see that from the total liabilities to free cash flow ratio and the debt to equity ratio here. So quite some debt actually compared to the equity that the company has as well. And this, coupled with the fact that their dividend yield is 4.7%, with a payout ratio of 107% if we're talking about the net income, and 59% if we're talking about the free cash flow payout ratio, makes it a little bit dangerous here. We're going to examine the dividends in a little bit more detail, but it's important to see that the company may not be as solvent as we want it to be right now. Now, the return on equity is still pretty okay, and the net income margin is sitting at about 10% here. Now, the 5-year revenue growth of the company has been going down, so this is a declining company in terms of sales, and it's something that you hate to see. This is something that I never like to see from companies, a decline in sales. I mean, it could be an okay thing if you're buying a company at a very, very cheap price. Yet IBM again has been trading at a range, and I'm not sure whether we are even close to this low price that would like to get it for. I would like to get a massive discount for this kind of decline in revenue growth, and net income has been about the same since 2017 really. It has had its up days, but now again going down. Free cash flow growth also going down, and it's only the total equity growth that has been a little bit better since 2017 here. So in terms of the dividends, we can take a look at the dividends of the company. You will see that they have been increasing their dividends in the past few years, pretty much almost every quarter. Now, in the past few quarters, it has been about the same, 162 and 163, 164, small increases, while in the previous years increases were a little bit steeper. Right now, they are at about they're almost flatlining, which could give you a hint that the company could even cut down on some dividends in the future, especially if they, of course, have some issues in terms of their payouts. And it's a lucrative dividend, again, 4.7%, almost 5%, at about 60% of their free cash flow, which is not horrible, but it can have a little bit of trouble for the company. It can be a little bit of trouble for the company to be paying out this kind of dividend yield for the next decade or so, maybe. But in the upcoming years, maybe the next 5 years, probably not going to be a serious issue, more than likely. I want to be taking a little bit of a look at the insider trades here. You will see that nothing suspicious here, not any buys, not too many sales either. For the most part, it's basically awards from the company and some options. Senator trades here. There is a specific senator which seems to be in love with this company since 2020. He has been purchasing more and more in lots of $1,000 to $15,000. Quite a few of those actually, and no selling for the senator. Although there are many other senators have actually sold, as you'll see, a sale full, for instance, another one over here, and it's another one, Josh Gottheimer, that was actually bought back in May of this year. So yeah, this may not have been the best call here, as you can understand so far. So in terms of trades here, we don't really have something that is alarming, really. It's normal stuff, it looks like, for the most part. And the last thing that I want to do for this video is use the stock evaluation tool to derive a value to pay, a stock price to pay for this specific company. Now again, the revenue growth has been kind of horrible for the company. It's been going down, and last year was horrible, minus 22%, minus 5 in 2020, minus 3 2019. Now of course, if the company kind of increases their sales at some point, you won't be seeing this kind of revenue going down and down forever. After losing quite some, almost like 30% of their revenue, they more than likely won't be declining at the same rate. Although it is always concerning to see a company having declining revenues. So for this reason, we're going to go for a low of minus 5% here, a 0% revenue growth for medium, and 5% for our high estimates. See what we're getting out of this. Now, the net income margins of the company seem to be at about 10%, and you will see here the company had 7, had 12, but I think going somewhere between 8, 9, and 10 is the sweet spot. Free cash flow margin, as you will see here, about 120, 130 maybe even. So I'm gonna go 110, 120, 130, and 13% for our annual return. This is what we want to be making. Let's hit calculate, see what we're getting out of this one. And as you would expect, we are not there yet, and it's only our high estimate that it's very close to the current price, and it's actually going to be green when the market opens, because it's the current price is going down about 6%, but more than likely, maybe even more when the market opens. And so we're going to be actually green for our high estimates with a 5% revenue growth. Now, is that a lot? It may actually be, because the company hasn't achieved that for the last 5 years, not even close really. They have been negative. So 5% may be a little bit of a stretch, but 0% may make some sense. And for 0%, we are sitting at $91. Now, based on what I'm seeing here, if I were to get this company, to get some of the stock of this company, I would want a discount, probably a pretty big one as well. So I would more than likely want to get it near this value, to tell you the truth. Maybe 50, 60 bucks, maybe 70 if I was feeling too lucrative here. But more than likely I wouldn't want to go near 90 or 100. It seems to be expensive at this range based on what we're seeing, based on the debt that the company has. Remember, they have quite some debt. And we can take a little bit of a quick look here. You'll see in our financial statements, if you take a look at the balance sheet of the company here, you will see that the total liabilities that the company has, if we take a look at the total liabilities tab here, oops, I need to go down, is about 113 billion, and it is down from what it used to be, but it's still quite some, 113 billion in terms of total liabilities. If we take a look at the cash flow statement, the company generates about 10 billion every year, maybe 15 in some years, and that's a massive multiple in terms of the 113 that they have in terms of the total liability. So they are not very solvent, and this can also be a little bit concerning. And the fact that they are free cash flow, their net income, their sales have been stalling or even going down, makes me want to get a much steeper discount. So this is where I would have my line in the sand for this company. I'd have to pay much less than 130. Again, I'd have to be probably less than half what the price of the stock is right now. And so for me, this is not a buy as at its current price today. Thank you for watching this video. Remember to leave a like if you did enjoy this one, and subscribe if you're not a subscriber already. Stay tuned. We're going to be having a lot of earnings reports coming out these days, and I'm going to be making videos about all of these. Probably Netflix is going to be the upcoming one, with some more that we actually examined earlier in the video. So again, thank you for watching this one, and I'll see you soon in the very next video. Bye bye, guys.